The Central Bank of Nigeria just sacked the board of First Bank Nigeria Limited and its holding subsidiary, and by doing so, appeared to have again underlined its resolve to preserve the sanctity of the commercial banking sector. For further analysis, we're now being joined here in Lagos by Chukwu, Capital Market Analyst and Managing Director and Chief Executive Officer, Cowry Asset Management Company Limited. Chief Chukwu, good morning and welcome to the program.
Dr. Ruben Abati, good morning.
You are laughing, but you are a chief now. Just claim your title.
I told you remind me of that chieftaincy.
Anyway, very quickly, what do you make of this board crisis in First Bank, and also how the CBN has reacted? What are the issues we should be focusing on?
Well, let me start by saying that what happened in First Bank is quite unfortunate. It could have been better managed both at the board level, because the truth is that the management they wanted to remove had only barely less than nine months to go, because Shola's tenure will end in December. His second tenure will end in December. But above all, there are issues that Central Bank came up with that should have been addressed much earlier than now. The issue of non-perfection of securities to insider credits, and Central Bank said that has been outstanding for the past 3 years. I think the board could have done better by addressing those issues. The reality is that if you look at Bofia stipulates that when a director borrows from a bank where he's the director, the first security he must offer is his shares in that bank. He must sign off the shares of that bank, his shares in that bank as collateral. So in the event of default, he will lose his status as a shareholder and director of that bank. That is very clear and very explicit. So anybody who is sitting on the board of a bank and borrow from that bank should comply with that as a minimum. Where you fail to comply, you are basically impinging on instant rules and regulations guiding the banking industry.
Thank you, Chief Chukwu. Now, the Central Bank Governor...
Judy, I
have joined Dr. Abati. The Central Bank Governor has gone to great lengths to detail the attempts he made at resolution and tried to manage the situation, as you've just said. But, obviously we all know it came to a head and he sacked the board. Now, I know you're not a judge, but what do you feel are the options before the sacked board if they decide to approach the court?
Well, they will have a very weak position. The truth is that the Central Bank has the latitude. Bofia 2020, even the Bofia, the First Bank and other financial institutions decree, when it was a decree, as it was promulgated by the Babangida government, made provision for the Central Bank to approve as well as to sack the board of banks. So even if these infringements were not the issues that they have brought up earlier, which the Central Bank said that right from 2016, the bank already had liquidity issues, they had solvency issues, they had capital adequacy issues, they had high level of non-performing loans. They were enough basis for the Central Bank to have wielded the big stick. The Central Bank has a latitude. If you go to the bank, and if you go to the court, and we've seen this right from the time when the then Central Bank under former Joseph Sanusi, the Central Bank, removed the Otumba from FCMB, First City Monument Bank. They went to court and they didn't win. Several instances we've had several examples of people who went to court to challenge their removal from the board by the Central Bank, and none of them have succeeded. So it would be a Herculean task if Tudeko and other board members think they can challenge the powers of Central Bank to remove them from the board. Remember that he who gives the power, who has the right to create, will also have the right to destroy, which is basically what has happened. Central Bank is the one that approves the board of directors of banks. Central Bank also has the powers to remove the board of directors of banks. These powers we are giving to them to ensure that they maintain financial system stability, so that if the board members become a challenge to the health of a financial institution, central banks will have the capacity to wear that big stick.
I mean, great insights. I'm not going to call you Chief Chukwu, but it's good to talk to you again. Well, real quickly, I just want to talk through the lines of corporate governance. That has been a sticking point in all of this. And the fact that we can even start to manage NPLs, that's non-performing loans, to the threshold of over 26%. In the case of First Bank, as it has been for quite a while, you know, what is really happening in the banking sector? Somebody will have thought, oh, our own kind of Dodd-Frank with the buffer we've signed, we'll be able to clamp at all of that. But it's a basket case. For it to degenerate to this extent is a shame on all of us. You know, we can come out here and sit down and say, oh, the Central Bank did what it ought to do to placate the situation. But it's a shame that it got this far. Non-performing loans of 26% after we saw what happened to Diamond Bank a couple of years down the line? A couple of years ago?
Seni, thank you for not sticking with Ruben with the chieftaincy here. The chieftaincy when I'm in the village. Okay, the way we look at it is that a couple of factors lead to an uptick in non-performing, and I'm going to explain that to the audience. One is that if the economic condition of that country becomes weak, then you could see a situation where loans go bad, not because the people who were granted those loans did not want to pay back, but because their cash flow diminishes as a result of weak economic conditions, particularly when the economy goes into a recession. So it could lead to an increase in non-performing loans. Second factor is where the credit approval process in the bank is weak. So the bank does not have, the board has not put in place the appropriate systems, checks and balances, the quality of staff that could properly appraise credit, and so you find that the bank creates very weak credit from day one. The third factor is where you have undue influence by key stakeholders in the bank. For instance, dominant shareholders who bring weak credits and influence the board, the directors to approve those credits. In the case of First Bank, those three factors may have contributed to the uptick in their non-performing loan in 2016 to 26%, as the central bank governor said. Remember, in 2016, the economy went into a recession. And the central bank governor also mentioned that there were issues of weak appraisal, weak assessment of credit. So you could actually have seen a situation where creditors shouldn't have passed through their furnace. If they have a strong furnace of credit approval, we are approved and granted, and when bad, immediately we are granted. And then the issue of high level of insider credits. So these factors contributed to what First Bank had in 2016, where they had non-performing loan of 26% of their total loan portfolio. So the question should be, what are the measures that should be put in place by the regulators to avoid such occurrence, or what should the board and what could be the red flags that could trigger the central bank and other shareholders to begin to ask questions, critical questions on how, because the truth is that if a bank has high level of non-performing loans, that bank is going to have liquidity challenges, it's possibly going to have solvency issues, and like the central bank said, that First Bank has capital adequacy issues, because if you look at their risk-weighted assets vis-a-vis their deposit, it had declined, it had worsened as a result of the stickiness of their credits.
Well, very quickly before we go, the CBN governor made a point about a certain individual, specifically Mr. Alba Ochudeko, trying to place himself above regulatory control. Is this standard practice in the banking sector? And are we likely to see more similar cases? We have just a few seconds to go.
I wouldn't say it's standard practice in the banking industry, but I know it has happened repeatedly in the Nigerian banking system, where either the founder, who is a major shareholder and a major influence peddler, brings undue influence to the management, because that key shareholder is also the one who virtually handpicked the management. So we've seen that in the past, which is why for systemically important banks, there are some policies that have been put in place to whittle down the influence of such critical shareholder.
Well, thank you very much, Johnson Chukwu, for joining us this morning on The Morning Show.